I'm Pacome Breton, member of the investment team at Nutmeg. Welcome to our mid-month investor check-in. In this month's update, I will give you a highlight of recent movement in UK asset and Brexit, movement in prices of US technology stocks, and as well what has been the price action in gold. The Brexit negotiations are now entering the latest phase with short deadlines, and the recent news flow isn't particularly encouraging, at least from a market standpoint. The internal market bill proposal from Boris Johnson wasn't really well received by the EU negotiators and even internally within the country. And as mentioned, it has directly impacted UK assets. The pound, for example, had its worst week since March, losing 3.6% versus the euro. And it was actually the third worst week since the Brexit vote, highlighting that not everything is already priced in the currency. The FTSE 100, which tends to prosper when the pound weakens, the FTSE 100 outperformed the US equity market by more than 6% over the week, which happened actually only twice since 2008. So overall, as you can see, a large reaction, and we should expect, unfortunately, to see more volatility coming in the next weeks. On our side, we have a slightly negative exposure to the pound, but would be worried to take a more negative view at this level, and we remain underweight the FTSE 100 for the long term. Effectively, the Nasdaq has reversed some of the impressive gains generated since the sell-off in March. It was somehow expected to see at least a pause and more likely a pullback, especially after the rally in August, with the Nasdaq gaining double-digit returns. There are always many reasons afterwards to explain a sell-off. Well, the first one, looking at it, is probably technical and due to market breeze. It's quite common that after such a market rally, we see a period of reversal without breaking the trend, and it was somehow due in the Nasdaq. We have seen as well a high level of option buying from retail investors in the US on one side, but as well by the large Japanese financial conglomerate SoftBank, largely reported in the press. It for sure can have an impact, especially as banks who sell the options, they need to buy the stocks or the index to hedge themselves. But it's difficult to believe that it was really the main reason. Mid-term, we remain positive on US technology stocks despite the valuation, with rates for us at such a low level and limited growth in many sectors. We are aware that we can see a period of volatility in the short term, but we think the sector remain attractive over the mid to long term. Well, it's true that gold has had a great run in 2020, pushed higher by lower bond yield and a rebound as well since March in inflation expectation, especially in the US. On this subject, actually, we've written 2 blogs to understand further the drivers of gold and why we added some in our portfolio. Like we saw with US technology stocks, there was a form of somehow exuberance this summer, and we noticed something similar with gold, and this has been partially corrected over the recent weeks. So gold overall is benefiting from the COVID-19 monetary stimulus that has impacted bond yield, inflation expectation, and more recently the US dollar, which has weakened quite noticeably versus the euro and as well other developed market currencies. With regard to the US election, it is difficult to believe that the US election by itself will have some huge direct impact on the gold price, especially as the Democrats, with Joe Biden, they've embraced a relatively moderate candidate versus other more radical thinkers that existed in the Democrat Party. However, the winner of the election and the size of his majority in the House and in the Senate can have some pretty meaningful consequences for the US deficit, its monetary policy, and ultimately bond yield and the fluctuation of the US dollar. And all this can impact gold, but more indirectly than directly. Thank you for joining, and hopefully to see you next time.